welcome back. The time is 6:22, and let's take a look at your money. High interest rates can have a significant impact on our household budgets. According to LendingTree, the average interest rate consumers are charged on a new credit card is 24.6%. According to Bankrate, the average interest rate on a 30-year fixed home mortgage is once again over 7%. But why have interest rates remained high for so long, and when can we expect them to start declining? Financial advisor Mark Gravicheski joining us now live on Zoom to break this down. Good morning, Mark.
Morning to you, Devin. Great to see you again. Happy Monday.
All right, yeah, let's get right to it. What's the relationship between high interest and high interest rates and inflation, that is?
Sure, it all comes down to the actions of the U.S. Federal Reserve, which actually sets our nation's monetary policy. When inflation starts to rise, the Fed will typically raise what it's called its Fed funds rate, which serves as a basis for many types of consumer debt. As the Fed funds rate is raised, it will inherently drive interest rates higher on credit cards, auto loans, bank loans, even home mortgages. The goal of the Federal Reserve is to actually increase the cost of borrowing. The Fed hopes that by making it more expensive, to buy things on credit, consumer spending will decline. And as spending drops, inflationary pressures should gradually ease.
So, if the Federal Reserve knows that high interest rates negatively impact consumers and businesses, why can't the Federal Reserve just lower interest rates right now?
Great question. Look, the Federal Reserve is in a very, very tough situation. Look, on one hand, it is fully aware of all this pain that high interest rates place on, consumers, businesses, and ultimately the U.S. economy. But if the Fed lowers interest rates either too soon or too fast, it risks a sudden surge in consumer spending because lowering interest rates actually incentivizes more consumer spending because it's now cheaper to borrow money. And if consumer spending suddenly surges, that could likely push consumer prices and inflation even higher. And look, that's the last thing the Federal Reserve wants to do is to drive inflation even higher.
And give us an overview on how the tariffs scheduled to take effect tonight could further impact prices for consumers.
Yeah, well, we need to differentiate between tariffs and inflation. First off, tariffs raise prices on the individual goods that are being tariffed. In the longer term, tariffs don't cause inflation, which is more of an across the board rise in consumer prices. Inflation, as we've seen, is more of an issue of money supply, which has literally exploded in recent years. Now, as we saw during Trump's first term, he's very quick to use the size and power of the U.S. economy literally as a hammer to renegotiate trade policy and border policy. Canada, Mexico, China, and look, even if he starts tariffs on the European Union, all of those regions and countries have a much weaker and less resilient economies than the U.S. The big question, Devin, is how long these tariffs last. We really don't know. But look, especially Canada and Mexico can't afford to have this drag on. But what we saw last time is that some companies initially will absorb the cost of these tariffs simply to stay competitive with their competition, whereas others are indeed much more quick to pass on those higher costs to consumers.
All right, this is something we're just going to have to keep our eye on, as we know. So thank you so much, Mark, for coming on, and thank you for that great perspective.
Yeah, a very fluid situation. We'll keep an eye on it, Devin. Take care.
That's right. All right, have a good day. And